Hey everyone, welcome back. Imagine turning your everyday spending into a money-making machine. Today, we're going to uncover the secrets that most people overlook when it comes to building wealth. I'm talking about simple tricks, small habits, and smart investments that can stack up over time. Almost like magic, but real. By the end of this video, you'll see how to make your money work for you, instead of the other way around. Let's dive in. Imagine waking up one morning and realizing that everything you thought you knew about money, investing, and growing wealth might actually be the thing holding you back. Most people approach finance with a set of assumptions that sound logical on the surface, but are quietly sabotaging their financial potential. They follow advice blindly, imitate others without understanding, and confuse luck for strategy. The first step toward financial transformation is to challenge these assumptions. It starts with a simple, powerful question. The kind that makes you pause, rethink, and see your financial life in an entirely new light. Asking yourself whether your current beliefs are helping or hurting you is more than a philosophical exercise. It is a practical tool that reshapes your decision-making and your approach to wealth. When you question your own understanding, you open the door to awareness, and awareness is the foundation of change. People often cling to conventional wisdom because it is familiar and comfortable. They read books, listen to podcasts, and watch videos that reinforce what they already think they know. They assume that by following the same path as everyone else, they will reach the same results. But here's the catch. The traditional approach often encourages mediocrity disguised as security. It discourages experimentation, fosters risk aversion, and overlooks the compounding power of small, consistent actions. The first keynote is about breaking that cycle. By introducing a powerful, almost shocking question, you are forcing your mind to confront the possibility that your current trajectory may not lead where you want it to go. This question works like a mental jolt. It interrupts autopilot thinking and creates cognitive friction, which is essential for growth. In practical terms, this might look like reviewing your monthly habits, investment choices, or spending patterns, and asking, am I truly in control, or am I following a script written by society? Often, people discover that much of what they do is reactionary spending because of social pressure, investing because of hype, or saving because someone told them to, rather than because it aligns with a deliberate strategy. When you confront these behaviors with a challenging question, you are creating a space for reflection. You start noticing patterns that were invisible before, and that clarity allows you to act intentionally rather than reactively. A powerful question also serves as a filter for information. In a world overloaded with advice, news, and opinions, your ability to discern what matters and what doesn't is crucial. Asking, is this actually helping me build wealth, or is it distracting me, allows you to prioritize decisions and avoid the pitfalls of overanalysis. Moreover, it encourages curiosity. Instead of passively accepting what others say, you become an active seeker of knowledge. You look deeper, explore alternative strategies, and critically evaluate results. This is how ordinary people begin to think like investors, entrepreneurs, or strategic planners. The impact of a single question is amplified when paired with reflection and action. Awareness alone is insufficient. It must translate into practical steps that challenge your previous assumptions. For example, if you believed that investing in stocks was too risky for beginners, questioning that belief might lead you to explore low-cost index funds, automated investment platforms, or educational resources that demystify the stock market. Suddenly, what seemed intimidating becomes approachable. The first keynote also emphasizes the emotional aspect of finance. Money decisions are rarely purely logical. Fear, greed, pride, and habit influence choices more than most people realize. By starting with a powerful question, you engage your emotions in a controlled way. You allow yourself to feel the discomfort of uncertainty while also motivating yourself to take corrective action. It is a subtle but profound shift from passive acceptance to active curiosity, which is the mindset that separates those who achieve financial success from those who struggle indefinitely. The art of crafting such a question lies in its ability to provoke introspection without causing paralysis. It should make you think, but not freeze you. For example, asking, what if I invested just 1% more of my income every month, can be as powerful as, what if everything I know about money is wrong? Both spark curiosity, but the former immediately suggests action, while the latter opens the mind to In both cases, the goal is to break habitual thinking and encourage a mindset oriented toward growth and experimentation. The underlying principle of this keynote is that self-inquiry is more valuable than following instructions. You can read all the books, watch all the tutorials, and memorize all the strategies. But without questioning your own approach, you will likely repeat the mistakes embedded in conventional wisdom. By starting with a powerful, shock-inducing question, you are effectively rewiring your mental framework, allowing you to absorb lessons critically and apply them meaningfully. Over time, this habit of questioning leads to more confident decisions. You learn to trust your analysis, balance risk with reward, and recognize opportunities that others might overlook. Your financial actions become deliberate, intentional, and aligned with your personal goals, rather than dictated by trends or external pressures. This keynote also demonstrates the importance of mindset over mechanics. While tools, platforms, and strategies are important, they are secondary to the mental framework through which you view money. A powerful question reshapes that framework, enabling you to see potential where before there was fear, an opportunity where before there was doubt. The compounding effect of asking the right questions is profound. Small shifts in perspective create ripple effects in your spending habits, investment decisions, and income-generating strategies. Each choice, viewed through the lens of intentional questioning, becomes an opportunity to optimize and improve. This approach is not about achieving perfection. It is about cultivating a mindset of continuous growth, curiosity, and strategic thinking. Finally, starting with a powerful question sets the tone for lifelong learning. Wealth is not a static target. It evolves as markets, technologies, and personal circumstances change. By embedding the practice of questioning into your financial life, you ensure that you remain adaptable, resilient, and proactive in pursuing opportunities. It primes you to think critically, act intentionally, and grow consistently. This is the essence of the first keynote. It's not just about investing money wisely, but investing in your mindset first. By challenging assumptions, provoking reflection, and sparking curiosity, you lay the groundwork for decisions that compound over time, leading to financial outcomes that are as extraordinary as the thinking that made them possible. One of the most common mistakes that beginners make when it comes to investing in personal finance is trying to outsmart the system instead of focusing on building consistent habits. It's easy to get caught up in the thrill of making a quick profit, reading headlines about the next big stock, or trying to predict the market's next move. The media, social platforms, and even friends can amplify this mindset, creating the illusion that success is about timing, luck, or finding that perfect investment at the perfect moment. The reality is quite different. Success in finance, and particularly in investing, is rarely about a single decision or a one-time stroke of brilliance. It is the result of small, deliberate, and repeatable habits compounded over time. Beginners often fail to grasp this because they are focused on outcomes rather than processes. They monitor their portfolios obsessively, jump in and out of positions, and react emotionally to every market fluctuation. While this seems active, it is actually counterproductive. Timing the market perfectly is nearly impossible, even for seasoned professionals. The factors that move prices, economic reports, geopolitical events, interest rates, investor sentiment, are complex, interconnected, and unpredictable. Believing that you can consistently forecast these movements sets you up for stress, mistakes, and disappointment. The second keynote is about shifting focus from trying to predict the unpredictable to cultivating habits that guarantee progress, regardless of market conditions. A habit-based approach emphasizes control over what you can influence, how much you save, how regularly you invest, how you educate yourself, and how you manage risk. These actions do not rely on luck or timing. They rely on discipline, consistency, and a clear framework. For instance, automating contributions to an investment account every month ensures that you are consistently putting money to work, capturing the benefits of compounding and avoiding the temptation to wait for the perfect moment. This small, repeatable action builds wealth steadily over time and removes emotional decision-making from the equation. Breaking things down simply is crucial because finance can seem overwhelmingly complex at first. Terms like diversification, index funds, options trading, and asset allocation can intimidate beginners, making them think they need advanced knowledge or a degree in economics to start. But the essence of good financial strategy can be expressed in simple, actionable habits. Saving a portion of your income, investing regularly, and living below your means are all straightforward, yet powerful habits that create a foundation for financial growth. When you simplify the process, you reduce the mental friction that often paralyzes beginners. Complexity breeds hesitation, and hesitation often leads to inaction. By focusing on simple, actionable steps, you build confidence and momentum. Another key aspect of this idea is understanding that mistakes are part of the learning process, and they are less damaging when your approach is habit-driven rather than timing-driven. Beginners who try to time the market often make large, emotionally charged decisions, buying high during excitement or selling low during fear. In contrast, someone focused on consistent habits will see mistakes as small deviations that can be corrected without derailing long-term progress. The beauty of habit-based growth is that it is resilient to market volatility. Whether the market is up, down, or sideways, disciplined, repeated actions continue to build wealth. This approach is not flashy or dramatic, but it is far more reliable than chasing short-term gains or attempting to anticipate every twist and turn in the market. Breaking down finance into simple steps also makes it accessible. Beginners often think they need complex strategies or insider knowledge to succeed, but the reality is that simple strategies applied consistently outperform complicated strategies applied inconsistently. Mastering small habits, like budgeting, automated investing, regular review of your portfolio, and incremental skill-building compounds over time into financial fluency, confidence, and, ultimately, wealth. Another dimension of this keynote is the psychological advantage. When beginners understand that consistent habits trump market timing, they gain peace of mind. They stop feeling the need to constantly check stock prices, watch financial news obsessively, or stress over daily market movements. Their focus shifts to things within their control: how much they save, how they spend, and how they improve their financial knowledge, which creates a sense of agency and reduces anxiety. This mindset also fosters patience. Financial growth is rarely instantaneous, and the compounding effect of good habits requires time. By embracing simple, repeatable actions, beginners learn to tolerate short-term fluctuations without panic, understanding that long-term growth is the real measure of success. Simplicity is not about settling for mediocrity. It is about maximizing effectiveness with minimal friction. A habit-focused approach reduces complexity, ensures steady progress, and aligns with the natural rhythm of compounding over months and years. It allows beginners to build confidence, gain experience, and develop a sustainable framework for wealth accumulation. Ultimately, the second keynote is a reminder that investing is a marathon, not a sprint. Beginners who obsess over timing and chase market news often burn out, make impulsive decisions, and miss the benefits of long-term growth. Those who break it down simply focus on building small, consistent habits, and trust the process tend to outperform over time. By mastering habits, you gain control, clarity, and a reliable path to financial success. You start to see that the real power lies not in predicting the market, but in mastering your actions, your mindset, and your behavior. Habit-driven investing and financial discipline create a system where success is inevitable, compounding steadily like interest over time. And as you continue, the simplicity of your approach allows you to scale, experiment safely, and explore advanced strategies without losing the foundation that keeps you financially secure. This keynote, when internalized, transforms how beginners think about money. It moves them from reactive, fear-driven decisions toward proactive, intentional choices. It reduces stress, increases confidence, and sets up a framework for long-term growth that is far more reliable than any attempt to predict market swings. By focusing on habits, simplicity, and consistency, beginners can build wealth sustainably, enjoy the process, and ultimately achieve financial independence without falling into the trap of chasing impossible timing. One of the most powerful ways to understand complex financial concepts is through relatable examples and analogies. Humans naturally grasp ideas better when they are connected to experiences we already know. And finance is full of abstract terms that can feel intimidating or overwhelming. The third keynote emphasizes that by comparing investing to something familiar, like learning card tricks, it becomes much easier to internalize the principles and develop confidence in applying them. Imagine learning a card trick for the first time. At the beginning, your hands fumble, you forget the sequence, and you make mistakes repeatedly. If you tried to perform for an audience immediately, you would likely fail. But with practice, repetition, and small, incremental improvements, you gradually build skill, muscle memory, and understanding. Over time, what once felt impossible becomes second nature, and your performance improves dramatically. Investing works in much the same way. Beginners often expect immediate results, looking for instant gains or quick wins. But the reality is that investing, like any skill, is a process that unfolds gradually. Small, consistent actions accumulate over time, and the compounding effect amplifies the results of these incremental improvements. Every month, every investment, every habit you develop adds to the foundation of your financial growth. By using an analogy like card tricks, you help demystify the process and make it tangible. Beginners can relate because they have experienced learning curves, frustration, and eventual mastery in other areas of life. The analogy serves as a bridge between abstract financial concepts and concrete experiences, making the learning process less intimidating and more engaging. When beginners see investing as a series of small wins rather than a single monumental achievement, they are more likely to take action. They understand that mistakes are part of learning, and that each decision, no matter how small, contributes to long-term growth. This perspective reduces fear and hesitation, which are common barriers that prevent people from starting or staying consistent. Another advantage of using analogies is that it encourages pattern recognition. In card tricks, the more you practice, the more you recognize sequences, anticipate outcomes, and understand probabilities. In investing, the more you observe markets, study trends, and practice discipline, the more you begin to recognize patterns, assess risks, and make informed choices. The analogy helps beginners see the connection between effort, learning, and eventual success. Furthermore, relatable examples make financial education more memorable. Humans remember stories and analogies better than abstract rules. When someone compares investing to card tricks, the lesson sticks because it connects an unfamiliar concept to a familiar mental image. This improves retention, encourages repeated practice, and reinforces the idea that mastery takes time. Relatable examples also build emotional engagement. When learning feels relevant and understandable, beginners are more likely to enjoy the process. They approach investing with curiosity and experimentation rather than fear and anxiety. Just like practicing card tricks can be fun despite initial failures, learning to invest becomes a rewarding challenge rather than a source of stress. This approach also shifts the mindset from instant gratification to long-term thinking. Beginners often expect quick returns and can be disappointed when results are slow. By framing investing as a skill-building journey with small wins compounding over time, the analogy teaches patience, discipline, and resilience. Each small gain is meaningful, and over time, the cumulative effect can be substantial. Using analogies also allows educators, content creators, and financial mentors to communicate complex topics with simplicity and clarity. Financial instruments like ETFs, index funds, bonds, or options can be confusing when introduced with technical jargon. But by connecting these instruments to everyday experiences or hobbies, beginners can understand their purpose, function, and risk profile in a way that feels intuitive. The card trick analogy, for instance, highlights that mastery comes from repeated, deliberate practice, and that early mistakes are natural and expected. It also subtly reinforces the principle of compounding, which is central to investing. Just as practicing a small trick repeatedly improves your skill exponentially, investing small amounts consistently allows wealth to grow exponentially through compounding returns. Another important aspect of this keynote is that analogies can inspire creativity and experimentation. In card tricks, learning new variations and discovering tricks independently is part of the fun. Similarly, investing can be approached with curiosity, testing different strategies, exploring various asset classes, and learning from outcomes. Relatable examples normalize experimentation and frame failure as part of the learning process, which is essential for long-term success. This keynote also emphasizes accessibility. Finance often feels exclusive or intimidating because it is presented in a formal, technical manner. Analogies make it approachable for beginners of all backgrounds, showing that investing is a skill anyone can develop if they understand the principles and commit to consistent practice. By relating unfamiliar concepts to familiar experiences, you reduce the perceived complexity and increase confidence. Furthermore, the card trick analogy reinforces the importance of incremental learning. Rarely do people become experts overnight, and expecting immediate mastery in finance sets unrealistic expectations. Analogies remind learners that skill, like wealth, grows step by step. Each action, lesson, and insight contributes to a larger foundation, and over time these small wins accumulate into meaningful outcomes. The analogy also helps learners internalize critical concepts like patience, discipline, and persistence. In card tricks, skipping steps or rushing through the process leads to failure, and the same applies to investing. Beginners who understand this are more likely to stick to their plans, maintain consistency, and resist impulsive decisions driven by short-term market movements. In addition, using relatable examples strengthens mental models. When learners visualize abstract concepts through analogies, they can apply the principles in different contexts. For example, understanding compounding through card tricks can help beginners grasp the importance of consistently reinvesting dividends, maintaining disciplined spending habits, or steadily increasing contributions over time. Analogies also bridge the gap between knowledge and action. Many beginners consume information without taking practical steps, leading to paralysis by analysis. Relatable examples clarify the path from understanding to implementation, making it easier to take small, consistent actions that lead to measurable progress. Finally, this keynote reminds us that learning is more effective when it is enjoyable and engaging. Analogies transform abstract or intimidating subjects into experiences that feel familiar, fun, and achievable. Beginners are more likely to remain curious, motivated, and committed when they can relate concepts to things they already understand. By using relatable examples and analogies, you make financial education accessible, memorable, and actionable, creating a mindset that embraces growth, consistency, and long-term thinking. Investing, like mastering card tricks, rewards patience, persistence, and repetition. And each small success compounds into remarkable results over time. One of the most important principles in personal finance and investing is the ability to translate knowledge into action. Many beginners and even experienced individuals struggle with taking the first step, often waiting for the perfect moment or obsessing over which strategy is best before doing anything at all. This hesitation is one of the most common reasons people fail to build wealth. The fourth keynote focuses on providing an actionable step that is simple, practical, and effective. The suggestion to set up a single automatic transfer to an investment account, even if it is just $5 a month, embodies the idea that consistent action matters far more than perfect timing or flawless decision. This approach emphasizes that small, repeatable steps are the foundation of long-term financial growth. When you commit to an automatic transfer, you remove the burden of decision-making and minimize the influence of emotions, which are often the biggest obstacles to building wealth. Fear, uncertainty, or procrastination can prevent you from starting. But by automating the process, you create a system that works independently of mood or market conditions. Consistency is the key. Even the smallest contribution, when applied regularly, begins to compound over time. Many beginners underestimate the impact of a modest, steady investment, thinking that only large amounts or perfect market timing will yield results. However, history and research have shown that regular contributions, even small ones, accumulate significantly over years and decades due to the power of compounding. By focusing on the actionable step of setting up an automatic transfer, you are creating a behavior that bypasses the paralysis caused by information overload. In today's world, there is an endless stream of financial advice, market predictions, and conflicting opinions. Beginners can spend weeks researching and planning without ever taking meaningful action. Automation simplifies the process and ensures that progress happens even when distractions or doubts arise. This step also reinforces discipline. By committing to a routine, you train yourself to prioritize saving and investing consistently, making financial growth habitual rather than habit formation is a powerful psychological tool because it shifts the effort from conscious willpower to automatic behavior. This is crucial because human willpower is limited, and relying solely on motivation can lead to inconsistency. The beauty of starting small, such as transferring $5 a month, is that it makes the challenge approachable. Beginners are less likely to feel overwhelmed or intimidated, which increases the likelihood that they will actually follow through. Small steps build confidence, and confidence encourages larger steps over time. Once the habit is established, Scaling up contributions or exploring additional investment options becomes a natural progression. Another important aspect of this keynote is teaching the principle of time over timing. Many beginners obsess over market cycles, trying to buy at the lowest point or sell at the peak. While timing can make a difference, it is nearly impossible to predict accurately and consistently. By taking immediate action, even with a small amount, you prioritize time in the market over trying to time the market. History has repeatedly shown that consistent participation over long periods produces better results than waiting for perfect opportunities that may never materialize. This action-oriented step also introduces the concept of systematized financial growth. Systems outperform goals because systems create repeatable processes that generate results automatically. Instead of setting vague intentions to invest someday or save more, an automatic transfer system ensures that every month, money is consistently put to work, reinforcing financial discipline and generating compounding effects without requiring constant thought or effort. Automation also reduces emotional interference, which is critical in investing. Emotional decisions often lead to mistakes, such as panic selling during market downturns or chasing hype during rapid market rises. An automatic transfer removes these emotional triggers, creating a steady, unemotional approach to building wealth. This keynote highlights the importance of starting immediately, even imperfectly. Many beginners delay action because they feel they need perfect knowledge, optimal timing, or a large initial sum. In reality, starting with even a modest, imperfect step is far more effective than waiting indefinitely. The act of beginning builds momentum, which is one of the most powerful forces in personal finance. Momentum encourages repeated action, reinforces habits, and increases confidence, creating a positive feedback loop that accelerates growth over time. Another dimension of this keynote is its educational value. By taking the first step and observing the results of regular contributions, beginners gain practical experience with investing, market behavior, and personal financial management. This experience is invaluable because it turns abstract concepts into real-world learning, helping individuals understand how compounding, diversification, and consistent contributions work over time. This step also cultivates patience. Many beginners expect rapid gains and become discouraged if results are not immediate. Setting up an automatic small contribution teaches that wealth is built incrementally and that's sustained. Effort over months and years produces meaningful outcomes. Patience, combined with consistency, forms the cornerstone of long-term financial success. Furthermore, the simplicity of this action reinforces accessibility. Anyone, regardless of income level or financial literacy, can implement an automatic transfer. It removes barriers to entry, demonstrates that wealth building is achievable, and instills a sense of empowerment. This empowers beginners to see that they do not need extraordinary resources or perfect timing to make progress. Adityonaji, this keynote underscores the psychological benefit of visible progress. Even a small, automated transfer allows beginners to see their portfolio grow over time. Watching progress, even if incremental, reinforces positive behavior, increases motivation, and encourages further action. The practice of setting up automatic transfers also lays the foundation for more sophisticated financial habits in the future. Once the initial habit is established, it becomes easier to explore additional strategies, such as dollar cost averaging, diversified portfolio allocation, or automated reinvestment of dividends. Each subsequent layer builds on the initial action, magnifying its long-term impact. The overarching lesson of this keynote is that action, no matter how small, is more valuable than indecision or waiting for perfection. Small steps, taken consistently, create compounding effects that far exceed the occasional large action taken sporadically. This approach teaches beginners to focus on controllable variables, prioritize consistent behavior, and trust the process. In conclusion, the fourth keynote emphasizes the transformative power of starting today with an actionable, simple step, like an automatic transfer to an investment account. It combines psychology, habit formation, discipline, and the principle of time in the market to create a system that produces results reliably and sustainably. By implementing this step, beginners not only begin their wealth-building journey but also internalize the mindset and behavior that will support long-term financial growth, resilience, and independence. One of the most overlooked truths in personal finance and wealth building is that lasting success rarely comes from luck or one-time events. Many beginners and even experienced individuals mistakenly attribute financial success to timing, windfalls, or chance encounters. But the reality is that wealth is the result of deliberate systems, consistent habits, and long-term thinking. The fifth keynote emphasizes that true financial power comes not from chasing isolated opportunities, but from designing and implementing systems that generate predictable, repeatable results. Understanding this distinction is crucial for anyone who wants to achieve long-term financial independence. A system-based approach focuses on the processes and structures that drive results, rather than the outcomes themselves. For example, instead of obsessing over picking the perfect stock, wealthy individuals focus on building a diversified portfolio, automating contributions, managing risk, and consistently learning from experience. The outcomes, profits, growth, and security are the natural byproducts of this system. This perspective shifts the mindset from reaction to control. Beginners often make the mistake of reacting to events, whether it's a sudden market crash, a trending investment, or hype-driven opportunities. Event-driven thinking encourages impulsive decisions, emotional trading, and inconsistent strategies, which frequently lead to losses. In contrast, thinking in systems provide structure, clarity, and predictability. Systems allow for flexibility and adaptation while keeping the core strategy intact, so short-term disruptions don't derail long-term progress. The power of systems also lies in their ability to leverage compounding. Small, consistent actions, repeated over time, such as monthly contributions, disciplined saving, reinvestment of dividends, or continuous skill building, accumulate into significant results. Each component of the system reinforces the others, creating exponential growth that is difficult to achieve through isolated actions or luck alone. This keynote also highlights the difference between mindsets and circumstance. Wealthy individuals understand that external conditions are largely unpredictable, but internal systems are within their control. By designing systems that function under various conditions, they reduce the impact of uncertainty and maximize the likelihood of success. This approach fosters resilience, patience, and consistency, qualities that are essential for building lasting wealth. A system-oriented mindset also encourages strategic thinking rather than reactive thinking. When you focus on events, you are constantly chasing after short-term outcomes, which creates stress, distraction, and inconsistency. Thinking in systems, however, allows you to concentrate on the fundamental principles that drive success, creating a reliable framework that produces results over time. One example is the difference between focusing on a single profitable stock versus consistently investing in a diversified portfolio. The former depends on luck, timing, and speculation, while the latter relies on proven principles, habit, and consistency. Over time, the systematic approach reliably produces growth, demonstrating that wealth is built through intentional design rather than chance. Systems thinking also encourages learning and adaptation. A good system is not static. It is designed to evolve as circumstances change. Wealthy individuals continuously refine their strategies, learn from mistakes, and adapt to new information, ensuring that their systems remain effective in a dynamic environment. This reinforces the idea that success is an iterative process, not a single event. Another important aspect of this keynote is its motivational power. By framing wealth creation as a result of systems rather than luck, beginners are empowered to take control of their financial future. They realize that consistent effort, thoughtful planning, and disciplined execution are far more powerful than waiting for a windfall or depending on unpredictable circumstances. This mindset reduces frustration, increases confidence, and encourages action. The twist in the motivational close is subtle but profound. Many people assume that wealthy individuals are simply lucky or have unique opportunities that others cannot access. While privilege and circumstances can play a role, the distinguishing factor is almost always their ability to think in systems. This shift in perspective is transformative because it moves the focus from external conditions to internal control, teaching beginners that they too can design systems that work for them, regardless of starting point. Systems thinking also fosters long-term vision. Wealth built on isolated events is fragile and often fleeting, because it depends on outcomes that cannot be repeated reliably. Systems, however, are designed to function consistently, producing reliable results over extended periods. This approach encourages patience, long-term planning, and strategic investment, which are essential for financial security and independence. The application of this principle is broad. It extends beyond investing to include budgeting, income generation, skill development, and even lifestyle choices. By thinking in terms of systems, you create frameworks for continuous improvement, compounding learning, and scalable results. This approach ensures that your efforts are cumulative rather than sporadic. Another key benefit of systems thinking is that it encourages risk management. When wealth creation is approached as a system, each component is designed to minimize unnecessary risk while maximizing potential growth. For instance, diversification, regular contributions, emergency funds, and ongoing education are all system elements that protect against unpredictable events while supporting long-term goals. In contrast, relying on luck or singular events exposes individuals to unnecessary volatility and uncertainty, making it much harder to achieve stable, sustained growth. Systems thinking also reinforces the importance of habits and routines. Every wealthy individual follows disciplined routines that form the backbone of their financial system. These habits, whether daily, weekly, or monthly, compound over time, creating a structure that produces predictable results. Beginners can replicate this approach by establishing simple, repeatable habits that align with their goals. The motivational aspect of this keynote is amplified by the realization that building wealth through systems is within everyone's reach. It does not require extraordinary luck, insider knowledge, or perfect timing. By focusing on controllable processes, anyone can design a system that incrementally improves their financial situation and ultimately leads to long-term wealth accumulation. This keynote also teaches resilience. Systems are not derailed by short-term setbacks or failures. Mistakes, market fluctuations, and unexpected events are absorbed by the system rather than causing catastrophic failure. Over time, consistent application of a well-designed system outweighs temporary losses, reinforcing the value of discipline, patience, and persistence. Another dimension of this idea is empowerment. By thinking in systems, beginners realize that they are not at the mercy of luck or chance. They have the ability to structure their actions, manage risks, and make decisions that accumulate toward their long-term goals. This perspective instills confidence, reduces fear, and motivates consistent action. Finally, the fifth keynote encapsulates a mindset shift that is essential for long-term success. It reframes wealth creation from a lottery-style game of chance to a strategic, disciplined, and repeatable process. By understanding that rich people succeed because they think in systems, not because they experience lucky breaks, beginners are encouraged to design their own financial systems. These systems prioritize habits, consistency, and incremental progress, resulting in outcomes that are predictable, scalable, and sustainable. The lesson is clear. To win long-term, focus on building structures that work for you repeatedly. Leverage compounding and discipline, and trust the system rather than waiting for a lucky event. By internalizing this principle, beginners adopt a proactive, empowered, and resilient approach to financial growth, setting themselves up for sustainable wealth and financial independence over time. So, when you step back and look at the bigger picture, the path to financial success isn't about luck, flashy tips, or trying to predict every market move. It's about asking the right questions that challenge your assumptions, focusing on consistent habits instead of chasing timing, learning through small wins, taking actionable steps immediately, and thinking in systems that compound over time. Each of these key principles works together like a machine. Curiosity fuels learning, habits drive consistency, action creates momentum, and systems ensure long-term growth. If you embrace these ideas, even small steps taken today, whether it's saving, investing, or learning, will grow exponentially and put you on a trajectory far beyond where most people ever get. Wealth, real wealth, comes from thinking strategically, acting deliberately, and trusting the process rather than waiting for a miracle. Remember, it's not about what happens to you. It's about the systems you build, the actions you take, and the mindset you cultivate every single day. Start small, stay consistent, and let time and compounding do the rest.